Roth IRAs. Maybe not the sexiest topic of all time, but something that I think a lot of our listeners are thinking about when it comes to their retirement accounts. So, you know, going off of the basis, you've got typically your Roth, and for the sake of this conversation, I think we'll talk about Roth IRAs and 401ks kind of in the same vein, just because those are going to go hand in hand with each other. Tax implications are the same. It's just a matter of where they're sitting necessarily. Then you've also got your traditional IRAs and then your after-tax accounts. And that's kind of the three traditional buckets that we think of when we think about Roth IRAs. And I think and other, investment and retirement accounts. And so I think today what we want to focus on are strategies around when it makes sense to contribute to Roths, what they are in the first place, and then how to potentially convert traditional IRA assets into Roths to come out with the best possible outcome for our clients, for individuals, for those of you who are listening, thinking about, hey, where should I contribute? How should I be thinking about my retirement accounts? And just providing some insight into those things.
And that's a great, pivot back to a conversation that kind of underlies a lot of what we talk about, that asset location issue of where to put your money matters so much in this business, primarily for those tax implications. And then once we get into Roth conversions, especially, but also the decision to, contribute to Roth as opposed to a traditional IRA can be a very complicated decision. There are a lot of moving parts in this, again, especially for those conversions. And so, that's something that I want to talk about today and really is person by person. And so as we're, looking at this, it's kind of hard to not pull rules of thumb because most things in finance, okay, you're explaining them to people. It's easy to come up with a few, rule of thumb here and there to give you an idea, but these situations are so complex and can vary so much person to person what everyone's individual journey looks like that it's really hard to come up with those. So that's where we really like working with people on a one-on-one basis, get to know their circumstance because that matters so much more.
Yeah, I completely agree. I think when you get into some of the complexities here, it's valuable to have that advice. But at least hopefully we can talk today about how to, start that conversation, start being thoughtful about it, because it can really make a big difference to your retirement outcome if you place your assets in these correct categories. And so today, really focusing on that Roth IRA and what a Roth is. So I think we should really start off with the basics. What is a Roth IRA? Well, it's a retirement account that's funded with after-tax dollars, and it's tax preferenced. So the benefit of a Roth IRA is that you're going to invest in it every year as long as you have earned income, and we're going to get into some of the specificities there. But it's going to grow tax-free until sometime in retirement, you're going to pull those dollars out, but you aren't going to go any taxes on them. So that's really the power of a Roth, is that one day you can pull out however much money that has grown to via investments in stocks, bonds, other investments, and you can benefit from a tax-free withdrawal. So nothing owed to the IRS at that point. You're paying that up front because it's part of your income. So you're using those after-tax dollars. And then you get to benefit from all of that growth that you had over the years that you were contributing. And then, subsequently in retirement, you can pull those dollars out without owing anything to Uncle Sam.
Yeah, and that's a huge benefit to these because not only are you, not paying tax on those gains along the way, but it, gives you kind of an in-between choice, something different from your traditional where you can tax defer. But then you're paying, long-term or short-term gains on your individual account, or a traditional IRA where you tax defer on the way in, but on the way out, everything comes out as income, which in some cases can be worse than putting it in an individual account and just holding it long-term basis. And so really to your point about the IRS not really caring about these accounts too much at that point, once the money is in the Roth account, is that you don't have required minimum distributions like you do in traditional IRA accounts. Whereas, traditional IRA, you turn 73 and the government requires you to start taking some of this income because they want that tax money at some point. They don't want you to just hold on to it forever. They want to see those tax dollars eventually. And so they require you to pull money out of those accounts. Well, they've already gotten their tax dollars on your Roth, so they don't care. So you can hold that as long as you want to, as long as you live, and then pass it on potentially. That's a whole nother conversation about the estate planning. But realistically, you don't have to abide by those minimum distributions. You don't have to realize income per the government schedule, and it's actually not incurring any income taxes anyway. But it helps you kind of manage your tax situation as well, so you can manage those withdrawals to your terms, not the government's.
Right. And as long as you're making qualified withdrawals, after age 59 and a half, then you don't have any penalties for withdrawing from the Roth. I mean, the only other contingency being that the Roth has to have been funded for at least 5 years before you can make qualified withdrawals. But ideally, you're starting early in life, or maybe just early in retirement with your Roth, and so you're gonna have a runway in front of you to be investing, and then you're pulling out subsequently after a 5-year period. Now, when it gets to the contribution side, it's relatively easy. You can contribute $7,000 a year to a Roth unless you're over the age 50, in which case you get a $1,000 catch up, meaning you can contribute up to $8,000 per year. And that the only requirement there is that you have to have earned income. So if you work a job, you've got some kind of income, from some kind of employment. As long as it's 7,000 or 8,000 in the case of being over 50, you can contribute that to a Roth. Now, the one stipulation, and this is where we're going to get into this Roth conversion conversation, is that you have it. There is a cutoff as far as how much money you can make before they don't let you contribute to Roths anymore. And we'll get into in a second why it's kind of silly, because you can do what's called a backdoor Roth conversion from an IRA. But essentially the cutoff is about $165,000 if you file as an individual. At that point, you can't contribute to a Roth anymore, and that's an annual income. And then if you're a household or a couple, $246,000 is the cutoff before you just can't contribute to your Roth anymore. So contributions, relatively simple, $7,000 or $8,000 a year, have to have earned income, and then there's a income threshold where you can't contribute anymore.
Yeah, and so at that $7,000 to $8,000 a year contribution with those income limits, for a lot of high earners, that pretty much excludes Roths from the conversation. Outside of what you mentioned, that availability to do a Roth conversion, where you take a traditional pre-tax IRA and you pay the taxes on it now, and it converts into a Roth, and so you get all the benefits of having a Roth account. You do need to pay the tax on it now, which is part of the deal. And where that tax money comes from is a big deal. You generally want to pay that out of cash, not out of the account, because Roth dollars are generally seen as more valuable than non-qualified dollars. So that's essentially another way of adding dollars to that Roth account, is by paying those taxes out of cash. But that's really the big way that people can move large amounts of money into a Roth account, because not a lot of people can accumulate significant holdings or positions in a Roth just on your $7,000 to $8,000 a year, given the stipulations around it.
Yeah, I think most people are going to be fairly familiar with a traditional IRA because they started with a 401k at an employer. The employer matched, and that's how that retirement account got built up. From that 401k, once they left their employer, it was converted into an IRA most likely. And so you have those dollars which you can convert into a Roth. And so in this conversation, we want to give some strategies about when it makes sense to do a Roth conversion. And I think it's particularly helpful whenever you have low income periods. So whether that's you're early in your career and maybe you've amassed an IRA already, but you're in a job where you're not really peaking out too high as far as income tax bracket. I'd say if you're in the somewhere below the 24% or really below the 32% tax bracket, because you're going to be in the 24 or less, makes sense to do some of that conversion. And this is where we work with clients, making sure their tax obligation at the end of the year is not too high, because once you start converting pieces of your IRA, it adds to your income as far as the IRS is concerned. So you don't want to jump up into a new tax bracket, even for those marginal dollars that you're converting. And so times like whenever you have a relatively low income, you may be early in your career, hopefully you're just contributing to your Roth at that point. But then maybe you have a gap between jobs, maybe you're, unemployed for 6 months and you're going to have significantly lower income. If you have an IRA set aside, it may make sense to pay the taxes now at that lower income tax bracket. And then you can have Roth assets for the rest of your life and your career. And then a lot of times what we commonly work with clients on are when you're early in retirement, maybe your Social Security hasn't hit yet, so your earned income is extremely low and your investment income is relatively low. You can use up that space in those next tax brackets to convert to Roth. You may not be pulling out retirement assets for another 10 plus years. And so that can all grow tax-free in your Roth rather than tax-deferred in an IRA, whereas you could on that IRA be paying a higher tax bracket in the future than you are today.
Yeah, and I think it's really important that you bring up tax brackets because of how they fundamentally work, the bracketed nature of it. Whether it's you're between jobs for a couple of months, so this year's salary is relatively lower, or you're just not making quite as much and you have that opportunity to fill up those brackets. We really promote doing that because you don't have to do a full Roth conversion. It doesn't have to be all or nothing. You can do parts here and there to where if you have another $10,000 of income until you hit a higher tax bracket, you can go ahead and fill up that 24% tax bracket with Roth conversion dollars and leave the rest for a future year. You don't have to do it all at once. You can take it piece by piece and really be tactical with, how you recognize those taxes.
Yeah, absolutely. And so by using a combination of tactically analyzing where you're going to be as far as your tax bracket, converting the right amount so you're not overpaying your taxes, and then analyzing, what's your timeline? What's your time frame look like before you anticipate pulling out retirement assets? You can really set yourself up in a good way to benefit in the long term, because we really advocate for really having a combination of assets in these three categories: your traditional IRA, your Roth, and your after-tax non-qualified accounts, because of the way that you can work your tax situation. Sometimes it may be better to have assets in one category versus another, but by having a combination of that, being thoughtful about how you are saving, proper asset location, as you mentioned earlier, then you can really set yourself up for better success, because just the tax benefit alone can make a huge difference in your retirement accounts.
Yeah, it's a lot of flexibility when you have different pools to pull from, that you're not beholden to one situation that might, cause your income to peak one year and trough the next, whereas you can even that out depending on where your investments look like. And not only in for your own sake, but also this kind of leads into the broader estate planning portion of it, which is a very complex and even more personal conversation that we're not going to super get into today. But just know that there are very important estate planning implications for these. And a lot of times Roths can be friendlier to future generations than IRAs. Whereas you might not want to do a conversion if you're planning on donating this IRA to charity, because they're not going to have to pay taxes anyway. So there are certain estate planning considerations to make, and they can be very powerful tools when you're considering, what that's going to look like for future generations. And then kind of as you mentioned before, I kind of want to just highlight this real quick, is that because you didn't recognize that income when you put money into a traditional IRA, that's, tax deductible contribution, or not deductible, but it doesn't count against your income per se. It's going to count against your income whenever you convert it to a Roth. So it is, kind of as we said before, but it is adding to your taxable base there. So, keeping that in mind as you're going along.
Yeah, I think the considerations are important here. So I hope that we've identified the values of a Roth account. I mean, I think people kind of get it when you can just say, hey, this is going to be tax-free money that you can withdraw in the future. You don't have to worry about tax implications. I think it's not hard for people to understand that's a benefit of an asset to have. Now, it is to your point, it gets into the tax brackets and at what time of your life you're looking at making these conversions and these contributions, because that's when you can decide, hey, is it going to mathematically make sense for you to do this? And to your point, you really have to consider your income, I'd say in 3 kind of buckets when we're having this conversation: your earned income from whatever kind of employment, your investment income, whether that's dividends or other income streams from your current investments that are in after-tax accounts, and then 3, the amount that you're thinking about converting as far as from your traditional IRA to your Roth IRA, because all of those are going to add together to determine your income level for the year. And then I guess maybe a 4th category would be if you're in Social Security, if you're getting Social Security checks, those are also going to add to that as well. So incorporating all of those things into, hey, what tax bracket should I anticipate being at? Because we want to stay shy of those highest tax brackets when we're doing these conversions so you can get the most out of those Roth accounts. I think it's also important to note that whenever you do a Roth conversion, you want to pay the taxes due on that conversion with cash that is not currently invested. So you certainly don't want to be using the traditional IRA dollars that's tied up in investments. You don't want to be using that to pay for the conversion because the math just really doesn't work out there. We can run analyses for people if you're interested in looking at some of this, because it's just not going to benefit you in the long term. You're taking too much out of your investment pie. Similarly, you really don't want to be pulling even at necessarily long-term capital gains to pay for this, because it's just removing some of that tax benefit since you are going to be paying taxes on this. But if you have cash set aside, whether that's in an after-tax account or that's in your checking or savings account to pay for the tax on the conversion, it really makes sense mathematically. It's a really good investment, as long as you have the right timeline, are in the right tax brackets to be doing that. And then also, I think it's important to note a consideration, and this can also be looked at as a benefit, and you kind of alluded to this when you're talking about managing, estate planning and retirement planning, is having a Roth just in general can help hedge you against higher future income. If you're young right now, you may not be, you may be somewhere in the middle kind of tax brackets, but if you can amass a Roth that's a reasonable size, or like we said, convert to a reasonable Roth, well, if you end up having higher income down the road, maybe in retirement because of investments that you have, you're also going to have this Roth that you can potentially pull from that is tax-free. So that's not going to add to your tax liability when you're talking about your retirement benefits. You mentioned required minimum distributions earlier. If you can balance the amount you're pulling from a traditional IRA with a Roth, it's going to help limit your tax liability. So I think these are all things worth considering when you're doing this analysis.
And so as we go through this, I think it's, Roths have a lot of attributes to them, a lot of benefits, but I think it really comes down to current tax bracket versus future expected tax bracket. And so, again, taking advantage of where those current tax brackets are lower. But I think looking at future tax brackets, there are kind of 2 things I want to point to is one, protecting yourself from future increases in tax brackets themselves. It's not set in stone what Congress is going to do under any given term. And so they, fluctuate a little bit. And so having post-tax dollars in a qualified account does help add some level of surety to that, where you're not exposed to any changes that may be made down the line. And then the second thing I want to highlight is a lot of people underestimate the amount of income that they see in retirement, because you start, collecting Social Security, you start realizing gains on investments, moving to more, dividend payers, perhaps, things that you start left and right here and there, just start incurring more income because, I've heard it put a number of ways that are pretty similar to this, but, what days do you spend the most money? Usually the weekends. Well, what would happen if you retire and every day is your weekend?
Right.
People find that they have more time for the things they want to do. they spend more money than traditionally, and they end up in a higher tax bracket because of it. And so, that's a consideration I want to at least put out there for, our viewers and for our clients to consider whenever they're talking about these things, because a lot of people just think, oh, I'm going to retire, my tax bracket's going to drop to essentially zero or very close. And that's usually not the case.
Yeah, absolutely. So I think hopefully, kind of to wrap up here, I think hopefully we did a good job describing the benefit of Roth, tax-free dollars. We love things that don't incur tax liability. And then, I think for anyone who is amassing wealth in their retirement accounts, really thinking about, hey, where do I want to contribute first is very important. I think first and foremost, you want to be contributing to your 401k when you have employer match. That employer match is typically 1-for-1, which means you're getting 100% return on those dollars immediately. So that would be the first bucket that I would fill up, and just to that employer match to get 100% of that. And then I think the Roth, if you still qualify for Roth, really makes sense. Like I said, like we said, you're creating those different buckets. One, you've got tax deferral, then you've got tax-free sometime in the future. And then after that, it's probably going to be a combination depending on your tax bracket. This is where you'd want to work with a financial advisor, kind of discuss, does it make sense for me to just contribute to a non-qualified account that is going to be taxable, but you're talking about capital gains taxes, which at long-term capital gains, you're probably paying in the 15 to 10% tax bracket for most individuals, which is pretty attractive, versus does it make sense to be more into my IRA that's going to be tax deferred, but as you mentioned, your tax bracket is going to be a little bit more flexible in retirement, which can lead to benefits and issues potentially. So I think really following that line, employer match, Roth, and then a combination of your back to your IRA and non-qualified account is probably where you want to go. And all this being said is that I think this is how it's worth being thoughtful about this. But if you have a complex financial situation, it's valuable to work with individuals like ourselves to get some input on this, really maximize the tax benefit of these accounts. We preach asset selection and allocation all the time, but asset location can be just as important.
Absolutely. And then not even to mention, estate tax implications and all of that other stuff. This can get very complicated very quick. And I wish there was a easy, set in stone for everybody just across the board, do this and it's the best way to do it. But that's not the situation. But it is good to take a look at individuals' circumstances, and feels very gratifying to find the best combination of accounts for them because it is such a personal thing.
Absolutely. Well, if you have any questions about Roth accounts or retirement accounts, drop us a comment below this video. Check out our other resources at beckcapitalmanagement.com. And for anybody who's interested in having a more detailed conversation, please contact us through our website. Hunter, it was great talking to you about this topic today.
Yeah, you too. Thanks, Victor.